Hey everyone, this is Julian from the Binary Lab. In this video, I'm going to talk about the falling knife and how to trade the falling knife. So, you may have come across this term. A lot of you are familiar with things like triangles, rectangles. These are the most common ones. But what you may not have heard of so often, which you may have heard of sometimes, and I actually came across this coming up more often in the recent market situations, and that would be the falling knife. So what is a falling knife, and why is it called a falling knife, and how do you trade a falling knife in binary options trading? A falling knife is typically like alright, when you see the market is consolidating, this could be because of a it could be because there's a well-anticipated news event. So until that event is coming out, you find that the price action is sticking together, and if you're actually in the habit of using indicators, you have like the Bollinger Bands out there, and with the Bollinger Bands out there, you find that suddenly it's all very jam-packed together, right? Like the bands are not spread out far apart, right? And all of a sudden, there's this huge spike or a huge drop. Okay, so it then becomes a falling knife because like sometimes, what if it drops down and then you see all the signs of a reversal but it doesn't reverse? Okay, so we experienced this on Friday with a couple of currencies. In fact, just about every single currency there on Fridays. One of the things about trading on Fridays is that like a lot of the markets are closed. The Asian market is closed. The European market, depending on the timing, could also be closed. And if you're trading the New York market and you see a news release which drives the market in a very big way, very often there's not going to be a reaction until the following week. So based on Eastern Standard Time, it could be like a Sunday. It could be like a Sunday night, right? That actually there's a reaction. So until that comes about, it's just going like that, and it could be extending, plateauing, and extending a little bit. Over the weekend, you might see a little bit of a gap up, and then it comes up, and then it could either go on to a full-on reversal, or it could continue down. A falling knife, like I said, is that when you see all the signs of a typical reversal, like you see a slowing down, a shortening of bars. And then after the bars go from long bar, let's say it's like fingers, okay? Like like the very last finger, the shortest one, or more like toes. Like if you look at toes, toes, you got your big toe to your small toe, kind of like all the way to the smallest ones. You see a slowing down the price action, and then suddenly you see a doji, a non-directional bar. Sometimes you even see like a pin bar. A pin bar is one that has a very short body but a very long tail. Or you see like either one at the top or one at the bottom, the pin bar, and then suddenly you think that the price is going to reverse, but guess what? It keeps going the same way. So a falling knife is used to describe when sometimes you think there's this huge opportunity. Okay, let's say if you can think of weddings when they take the bouquet of flowers and the bride goes like that, right? And then the people in the background, they're like very keen to get married perhaps, and they're going like literally like getting ready for a basketball tackle, and they're going like that, or like a rugby tackle, and then they go like catch. But thing is, when you catch this, you're not catching a prize. Okay, you're not catching a huge reverse. You think you're bottom fishing, you think you're top fishing, but the actual fact is that you're catching a falling knife, which does what? It slices your fingers off. So, which leads the point to say that if you take opposite direction trades on such a market, you could possibly, get burned a little bit. So that comes to the next point: how to trade a falling knife. Okay, so there are a couple of ways of trading a falling knife. The thing is that most of the time, okay, we have to look what day of the week is the falling knife happening. Okay, when is the spike happening? How do you protect yourself from a big spike or a big a big drop becoming a falling knife. That's going to hurt you. So, number one, look at the days of the week. Look at is there a public holiday? If there's a public holiday on a certain market that could be affecting that particular market, causing an imbalance of buyers and sellers, or people that will possibly buy and sell, then I suggest that if there's a big spike, the best bet is to ride the trend. Okay, so let's say I have a thing like this. Okay, so let's say if the price is moving in a range, sometimes when a lot of you are very, and including myself, I'm guilty of this as well. When you see that, like when you have a lot of indicators in your chart, often it will kind of cloud your perception of things, and you start to just automatically only look out for shapes. That becomes my problem too. Like I just start looking at, okay, where's the triangle, where's the rectangle, and where are all these common shapes? Either upward, the rising wedge, falling wedge, equilateral triangle and stuff. But I fail to notice, unless I remove all the indicators, I fail to notice that the price up to that point had just simply been doing this. So that's why it would have been impossible for me to draw triangles. But let's say if I took all the indicators away, I could see that, hey, the price is actually moving like this. And then suddenly, all of a sudden, we had the price come out like that, right? After a whole while of this, boom, like right out there. And then, it becomes, actually, when you remove the indicators, it looks bloody obvious that this is going to, it's a breakout. And if it's a breakout, I look at the various time frames, from M5 all the way through the H1, H4. It's like, hey, this is a breakout out of this zone that's been there all the time. And all I really need to do is to ride it. Or let's say if it's a breakout to the upside, then I ride it up. So if it's a falling wedge, like I said, the best way actually is to ride it until you absolutely cannot ride it anymore. Like I mentioned, like if it's on a Friday, or if there's public holidays, more often the market is going to have a very one-way action. And on those days, that is probably going to be a falling knife. Falling knife means that it's going to continue to go down or continue to go up. And this is going to be beneficial for people who like to trade breakouts. Okay, so as long as you see falling knife, or rather what is going to be a falling knife, you never actually think about this. Falling knife is something that you don't really know what it is until you know what it is. So until it's established itself to be a falling knife, it's going to be a breakout, and you just basically write it down. So use a reasonable amount of risk. That will give you a satisfactory return. Okay, and the key is the same. If it happens to not be a falling knife, then you might want to look to bottom fish or top fish after that. But if it turns out to be a falling knife, same thing applies. In terms of risk management, you want to be taking a trade that is small enough to enable you to possibly re-enter as many as another 2 times, or a small enough a trade is going to allow you to enter another 2 times, that at the same time, if you want that only trade, is able to give you a respectable return. Okay, and you have to make some adjustments, some comparisons here. Depending on your account size, sometimes it may not be worth it to do that, especially those of you with smaller accounts. A lot of you who are trading in smaller accounts, you can only do like the smaller accounts, your smallest trade on Hyper could be $5, $10, but on the binary, which is the longer term trades, the minimum starting could be $20, $24, $25. So think of that in consideration. Is it if you're typically doing $5 trades, then this trade you definitely cannot do. But if you like in my binary lab trainings, when I give trainings on my daily webinars, I tell my students specifically this. Okay, like look at the charts. If we're range bound, we're going to use our typical reversal methods. But let's say if it's trading outside of the range, then we have to use a little bit more of a chart pattern analysis to base the trades. And it's no longer going to be the hyper trades. We're going to be going for more of the longer term trades, and I specifically say, okay, this session, all right, this kind of trading is out. We have to do this kind of trading. It's either you do it on demo or you don't do it, or you use as small amounts of money as possible. Take note that you wanna manage your risk, right? We may not get it right in the first trade, and here's what happens if you do not get it right in the first trade. What do I mean? Let's say if you tried to catch the falling knife. All right, so if you try to follow the falling knife, right? You try to follow the falling knife, then if that trade works out, great. Then you have a reasonable return. But supposing that if it is not a falling knife, it looked like a falling knife, but the other markets were able to push the market back into balance again, and it's going to go back the other way, you are able to re-enter the trade again in a direction change and still make some money. Possibly this could be a double up. Alright, it could be an equal size amount of trade. And on the other hand, if you went for a top fish or a bottom fish, means like fishing for highs and lows on an initial breakout, expecting a reversal, but it continues to extend. The way to trade it is that the initial expiry that you took, okay, if it was a 1 hour, you're going to go in for another hour. Alright? And I personally believe that if I'm wrong twice in a row, I will then look at a higher time frame. I'll look for maybe a 4 time frames higher, 5 time frames higher. So if I lost 2-hour trades in a row, let's say if I went in once and the second trade I made an equal size trade, I lost both. Now let's say if I want to just equal this one, or I want to double up again, alright? If I martingale upon my first 2 losses on the next trade, I might go even higher. I may go like 4 hours, 5 hours sometimes. So depending on the time of day of my entry, this could be the last available expiry for that day. So this is how I manage the what do you call that, the falling knife. But final tips for this video before I end this video off is that, like I said again, indicators are great. Indicators tell a lot of information, but at the same time, always remember to zoom out your charts, and sometimes it also helps to clear your indicators from your chart. And if you cannot find any patterns, again, I always look out for patterns, but if I cannot find any patterns, I'll look for consolidations like this. And these are some of the things that sometimes only the naked chart will show you. Speaking of which, let's say if you're already part of the Binary Lab, we have advanced training for people who want to learn more in depth about trading without indicators. It's conducted by one of my very good students, and very proud of him, Jerry Singh, and he actually teaches how to trade without charts in his own set of webinars and private coaching as well, and with a whole set of videos that you can go through and learn how to trade without actually using any indicators. At the same time, if you're not already part of the Binary Lab, what are you waiting for? There's a link down beneath this video that you can click and join. It should be something like http://www.thebinaryLab.net/join-binary-lab. See you inside. Join the over 2,500 members in our daily live webinars and profit in binary options trading. Bye everyone. Goodbye.